Hello and welcome to the virtual startup lab. We'll continue our discussion on the sources of funds. There are different ways the sources of funds can be classified, can be explained, or can be examined. In this session, we will try to see the sources in the form of equity and debt. Equity holder has a residual claim and they get the right to vote and they also get the dividend. They are also called the owners of the company. But the debt is a liability. They don't have the right to vote. They don't get dividend, but they get interest. So therefore, one of the important classifications or important issue that a startup entrepreneur has to decide whether to raise money in the form of equity or in the form of debt. In equity, there are different types of capital. Equity is the money raised from the owners or shareholders, and the share is a unit of capital, and the share can be equity capital or preference capital. Even internal resources, the profit generated by the business, becomes a part of equity. And as we move along, we'll see each source in detail. Similarly, the debt, which is also known as the liability, is a money belonging to an outsider, can be in the form of term loans, can be raised by issuing bonds and debentures, or even the supplier's credit can become a type of liability. So therefore, the sources are many, and each source has its own typical feature, and the feature will decide the cost of the funds. So therefore, it is important to understand these sources, understand the features, understand the cost, then raise the funds. In this presentation, we'll focus on equity, and within equity, we'll focus on capital. The Registrar of Companies in India requires that a private limited company or even a one-person company or public limited companies to declare the capital structure at all times on their financial statements. And in case there will be any change also, the registrar of company needs to know. So therefore, presentation of capital, sharing of information of the capital is statutory. The companies are required to show authorized capital and the paid-up capital. Authorized capital is the maximum amount of capital the shareholders or the company is authorized to raise by selling shares. Yes, it is possible to increase the authorized capital, but authorized capital before you increase it, you cannot go beyond that authorized capital. And the paid-up capital is a part of the authorized capital which is actually invested, raised and invested by the firm. All companies must have an authorized amount of capital on their balance sheet. For private limited companies and one-person companies, it is 1 lakh. For public limited companies, it is rupees 5 lakh. Such capital is decided at the beginning of the firm's incorporation. As we mentioned already, on a later date also, this capital, authorized capital, can be increased by paying the necessary charges to the registrar of companies. The paid-up capital by default cannot be more than the authorized capital. The company has to issue shares of the amount that has been decided as a paid-up capital during the time of the incorporation. And this needs to be done within 16 days of the incorporation, 60 days of the incorporation of the company. The authorized capital and paid-up capital are shown on the balance sheet, but actual transaction cash inflows happen for the paid-up capital. So paid-up capital is included for calculating the firm's net worth or equity for deciding various loan criteria. However, the companies have a right to change the authorized capital, and Ministry of Corporate Affairs allows that change too by accepting certain additional fee for it. A fee of 5,000 for allotting the minimum authorized capital is there for a private limited company. And for each 1 lakh of additional capital, between 1 lakh to 5 lakh of authorized capital, an additional charge of 4,000 is there. And for each 1 lakh, additional 1 lakh of capital, from 5 lakh to 50 lakh, the additional charge is 3,000. And for 50 lakh to 1 crore, each 1 lakh increase in capital, the additional charge is 1,000 rupees. And above 1 crore, for 1 lakh of additional capital, it is 750. So that means to start a business, you show the authorized capital, and then later on you can increase the authorized capital by paying the necessary charges of the Ministry of Corporate Affairs. The practice is that many startups incorporate their company with a minimum required authorized capital of 1 lakh. And the rest of the money invested, normally they put it either as a loan, unsecured, sometimes they show that as a share application money or share premium. As a result, immediately there is no need for increasing the authorized capital and pay the necessary fees. So to start a business, it is better to have small authorized capital and let the business grow. And with the passage of time, you can explore the possibilities of raising funds from different sources. It has also been observed that majority of startups today are bootstrapped. You may ask, what is this bootstrapping means? Bootstrap is a situation in which an entrepreneur starts a company with a little capital. It is like strapping the laces of your boot. He said to bootstrap when a business is funded by the personal finances or from the revenues of the new company. So a startup is said to be bootstrapped. That means they use very small amount of capital with a personal fund, or the revenue generated is used to finance the business. So therefore, raising of capital is an important activity for any business, but definitely very important time-consuming activity for a startup. So the entrepreneur may spend his or her time to understand the nature, the regulation, the various principles, the various characteristics of the various types of the sources before committing to a particular source of capital. Thank you very much. We'll come back with more details or other forms of funds too.